it's Nancy from Nancy Chu Homes at Keller Williams and J Metro Group. You know, we keep talking about how fast this real estate market is moving. It's like boom, 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 boom. So many changes, right? Well, I thought about it and I realized that it's moving fast because finance and banking are now moving fast too. As a matter of fact, they've they might be the reason that SVB went under, for instance. The way how fast this market moved. Like, think about this. Capital has now become super easily accessible. So, what was SVB an example of, right? It was an example of push that button, take your deposit out right now kind of behavior. In 2008, right, when you had, people taking money out of banks, it would take you days to get large deposits out of banks, right? Now, these days, with Silicon Valley, it took them less than 48 hours to get all their money out. You could have gone to home on a Friday, right? Thought everything was fine. Over the weekend, a bunch of finance bros could have got on Telegram, had conversations, and freaked each other out and taken all their money out by Monday morning. Simply by how fast that push button technology really is to access and move your capital around right now. Think about that, right? And this whole click button behavior, you know, it's how lending works too now, right? Look at Rocket Mortgage. Click a button, get approved. When you go buy a car online, click a button, approved instantly, right? Is this the speed, right, of our new world order of banking? And do we need to recalibrate how we handle things because of how fast things move now? It's something to think about, right? This is what you think of when you hear the word efficiencies. Like you hear efficiencies a lot, right? So for instance, in lending, right? They talk about how much more efficient it's going to be because of automation. Desktop underwriting, right? Appraisals now. Appraisals can be drive-by appraisals. You can even get appraisal waivers now. The idea that a lot of the process is going to be automated, which, for the loan officer, that's fantastic because it means that the loan officer can go out and look for more clients instead of dealing with the daily hassle of dealing with the mortgage process, because so much of it is more automated moving forward. Those are the things that are happening across the world in terms of the tech, right? The tech is happening so fast that bankers don't even have time to evaluate a potential crisis, decide how to handle it. It could happen over the weekend while you're off work. Is this a problem? Is it a regulatory issue? Is it a supervisory issue? Is it a legislative issue? What is the problem? Who's minding the store, guys? Are banks being asked to self-regulate because we've, sort of deregulated so much? And are they failing at self-regulation? That's my instinct, is that they're failing at self-regulation. The banking system is designed to reward high depositors, right? Large depositors, right? So it's a little less designed to reward you and me who put our money in the bank, but a company that puts their money in the bank, a larger organization who puts their money in the bank, they get all sorts of, rewards in the banking system for doing so, right? So let's think about this. If we as a whole, after this incident, after this set of bank failures, if we lose faith in the banking industry as a whole, right, what do we see people start to do? People are going to start spreading their money around, right? Because if a banking institution, can only insure, the FDIC can only insure one, 250K account at a banking institution, what are people going to start to do? They're going to start to spread their money across multiple institutions. And if that same rule applies to organizations, companies, what are they going to start doing? They're going to start thinking about spreading their money around to a variety of multiple institutions instead. Okay? That's interesting because that means that banks will start to lose their large depositors. And if they lose their large depositors, what does that mean? That could mean that they have less money to work with. And if they have less money to work with, then we could be looking at sort of a dominoes effect of them being less interested in loaning out money to small businesses and consumers, right? So potential tougher criteria on lending to people like us, right? Because banking incentives, let me reiterate this, are designed to help to attract large depositors. So you get no fees, free checking, unlimited transfers, free wire transfers. These are all things that are used, right, to attract large depositors. And banks need large depositors that are putting in money that are amounts that are higher than what the FDIC will insure in order for them to properly do banking things, which is one of them being lending to consumers and smaller institutions and small businesses. I'm just saying, okay? Now, big banks, of course, have traditionally always been a lot more comfortable with large commercial lending over small consumer spending, right? Oh, small consumer lending, right? Um, Here, don't you, you've had this experience, right? Where you have a much better time working on a mortgage with a small regional bank or with an actual lending bank, like Guaranteed Rate, LoanDepot, one of these actual lending institutions. You probably have had a better experience with one of those or with more smaller regional banks than you did with, say, Bank of America, Wells Fargo, UBS, HSBC, these large international banks. These banks that are too big to fail. These banks, they have no interest in helping the individual consumer. You know, their their residential lending side, for instance, is not great. They're usually not very well structured. They don't pay that much attention to them because it's a pain, right? There's not enough money to be had doing a $450,000 loan out of Austin, Texas. That, that's like for them, it's like picking, change off the ground. Are they bending down to pick up a penny? I don't know that they are because it makes more sense that they would want to do large commercial deals, right? And you can't really blame them. I mean, you can, but you can't really blame them because the truth is they have to function within their regulatory constraints, right? And there's a lot of pressure on them to do what they have to do because they have to keep their shareholders happy and profitable. And, this just doesn't lend itself to consumer banking at, any level, really. So I don't know. This is the direction that things are going in. And that's why I keep coming back to, do we have to recalibrate how we handle banking in this country? Okay. Um, a couple of things that I kind of wanted to also touch on, which is I think that we're starting to see a decrease in that crazy wage growth, those crazy salary spikes that we were seeing in 2001, in 2021, 2022. It's definitely slowing down. And I think that, it's been looking a lot over the past year, like the consumers spending wildly, right? You saw those, the reports where it was like credit card spending is up, consumers are tapping into their savings. They're not saving as much as they were before. I think it looks like consumers are out, having a wild joyride on purchasing, random things. I actually don't know. I think that's what's happening. It occurs to me that it is possible that consumers are just spending more money on the same things that they were purchasing before. Like if it costs you 3 times as much to buy your groceries, it's going to look like you're spending wildly. But the truth is, you might really only be buying, the basic stuff you were buying before. Okay. So it's possible that that is happening. And what would the result be in that? Well, it may be that we are going to see over 2023 that the consumer is stretched a little more thin than we thought. All right. And if you take this whole, super fast paced Sonic the Hedgehog new order, what I'm calling the new world order of banking, It may mean shrinking credit capabilities of banks, right? So increased strain on potential credit lending to consumers. You know how you know that banks don't want to do, stuff like residential individual lending? Wells Fargo completely axed that department. They were like, we're not doing this anymore. That is how you know that it is just not their jam, right? When you have large banks just being like, we're just axing that department altogether. Um, so rents, if we also then see, so this is the domino effect that we're going to talk about. So if you see that salaries aren't necessarily growing anymore either, then rents will only reflect as high as wages are capable of going to. So hopefully we'll see, and this is actually probably a good thing, we'll see an overall slowdown on rent numbers, which would be wonderful. Affordability would be great. Another thing that we might see is I think you're going to see some commercial leasing break in the system. Look, I can't stop paying my mortgage or I'll be homeless. I can't stop paying on my car payment because then I won't be able to get to work. I can't stop paying Verizon for my phone because my phone is like the only thing that keeps me connected to the world, and I need it for both work and for communication, with my family. So those are things that I can't stop paying on. But if I'm experiencing a liquidity crunch, then that office space that I leased for my small business may not be working out the way I'd hoped. I may just say, tear up the lease, return the keys, and take that loss right there. Because that loss might make, the depositor, the loss there might actually make more economic sense rather than bleeding out for the next 5 to 10 years on a commercial lease. And in reality, there's far less repercussion in that than if I stop paying my mortgage, for instance, right? So let's talk about some of those recalibrations. Is it possible that equity capital investors need to readjust their expectations on what returns are right now? Is it possible that all investors in general need to readjust their expectations on what returns are right now? Um, are these double-digit cap rates feasible? This is what everybody wants, those double-digit cap rates. Is that possible? Is commercial real estate going to suffer a big equity loss, right? Are multifamily, purchases going to suffer a big equity loss? I mean, multifamily, I mean like large apartment buildings. How good is that cash flow of that investment, multi-investment property that you bought? How good is that cash flow? Because I'm going to tell you right now, cash flow is king. And if you bought it for appreciation, which is a longer term thing, okay, that's great. But if you bought at the lower cap rate thinking, well, I'm just going to ride out appreciation, all right. What happens when you need that money? What happens when you need that money? I don't know. Cash flow right now feels like it's more important to me, or at least that's just in my world. Is it possible that 2% is no longer the true baseline for inflation? I mean, we've been talking about getting to a 2%. Is it possible, given all of these things that are happening in this world? I mean, there are literally 9 other countries in the world that have less than 2% inflation. The rest of them all have, and it sort of stretches there all the way to like 100% inflation. I'm just saying, is it possible that a 2% inflation baseline just really isn't feasible anymore? And how much are we going to destroy our economy trying to get to an unfeasible baseline? And is it also possible that we're never going to get rid of inflation, especially in very specific pockets? All right. That would probably be both industry based and also potentially regionally based. Okay. So for instance, medical services. Medical services as an industry is always inflated, has always been inflated, and I believe always will be inflated, right? How much does it cost to take this pill? I think this is a $56 pill. Oh, I had to go to the emergency room. They had to put an IV in me. That's a $2,000 IV. That's inflated, right? And it's possible that medical services will always be inflated. Or what about inflation that exists regionally, right? Is it possible that, you know, um, pockets of areas that are very close to large urban metros that employ a lot of people, is there always going to be higher inflation there? So, for instance, Jersey, like us, we are located next to a large urban metro, New York City, and it employs a lot of people. So it's possible that our area is always going to suffer supply and demand based inflation just because of the number of people who congregate in the area in which we live. I'm just putting these things out there for thought, because is it possible that we need to go back and reevaluate some of the things that and how we're handling it in banking, in finance, in lending, because that definitely all affects the business that we're in. And of course, as consumers, it affects the lives that we live. All right, guys, thanks for listening. I'll talk to you guys next week.